think gold and Bitcoin will probably outperform real estate over the next 5 to 10 years. We're going to have a capex supercycle. The holy grail is going to be artificial general intelligence. Gold has taken the front page right now. I think it's going to pause, and other asset classes are going to take the mantle. I think we go to 74 to 7,500 by the spring.
Which has more upside right now, Bitcoin or gold?
And I would suggest to you that
our next guest is Jim Thorne. He is the Chief Market Strategist at Wellington-Altus Private Wealth. He's returning to the show once more to give us his update on market conditions, current market conditions. Jim is calling for $5,000 gold, and previously on my show, he said Bitcoin's going to $500,000. We'll find out when and how, and what's currently going on with investor sentiment right now. Jim, welcome back to the show. Good to see you.
Good to see you, Dave. It's been too long.
It's been too long. Time flies when the market's flying as well. Let's talk about this market flying. There seems to be some profit taking, the precious metals today. We'll talk about that. But broadly speaking, just back up a minute. Why are you so bullish on alternative assets?
Well, I think go back to the first conversation we had. It's almost a year ago, where we said that if Trump gets elected and he doesn't put in a good Secretary of the Treasury, we have a real shot at a financial crisis. And what President Trump did is he put in Scott Bessent, who's probably going to go down as one of the top Secretary of the Treasuries that we've ever had. And so what are we getting from him? We're getting supply side economics, and we're getting a deficit that's starting to decline. And so we're starting to see evidence that the Trump administration is deficit friendly. We're seeing the 10-year yield dropping below 4%. Remember, Dave, a lot of people were calling for 10%. And so we've got a situation where, the fears from last year are being put aside. And then I would add to you is that, look, we are in a technology wave. The Fed is going to start cutting or continue to cut rates. And in the big, beautiful bill, President Trump has said that he's going to do 100% tax deductibility on capex up until Jan 1, 2031. So we're going to have a capex supercycle. The holy grail is going to be artificial general intelligence. We've got to grow electricity capacity somewhere between 90 and 100 gigawatts. David, a nuclear reactor is 1 gigawatt. So we're very, very early on in this theme. 7,000 for the S&P was my target coming into this year. We're just chugging along. I haven't changed my target. And, now what I would suggest is going to happen is, parabolic moves are to be sold. I would suggest to you that they're going to sell gold and they're going to buy Bitcoin, and we're going to climb the wall of worry higher.
The issue is at what point in the parabola, so to speak, should we start booking profits? How do you make that decision when something's rising parabolically? At what point, or what indicators do you as an investor look at to make a stop?
Well, it would be the chart right now. I mean, look at what gold and gold stocks are doing right now. And really nothing has changed in the narrative. Let me be totally clear. I am still a long-term bull on gold. I do not suggest you buy parabolic moves. So what I would suggest you do is look at, I think there's going to be a retracement back to the Fibonacci level of 61.8. That's about, in gold, that's about, 3,700, and so, or go back to the 50-day moving average. We're going to have a pullback, a grind sideways, and then a move higher, just like Bitcoin has been going through right now, a very, very frustrating consolidation pattern. So in terms of the long-term thematics, nothing has changed. Where I will push back, David, is if I hear too many people saying that this is the end of the US dollar and this is the end of the US Treasury. And I completely disagree with that point of view.
There's a theory circulating on the internet. I think it started with a Russian economist that the U.S. is trying to devalue away its debt, its $37 trillion worth of debt, by issuing stablecoins. Now, I don't know if there's any credence to that theory. But essentially, if the Genius Act mandates that new stablecoin issuances have to be backed by U.S. Treasuries, well, essentially they're creating demand for Treasuries, basically forcing people to buy off their debt. That kind of makes sense when you think about it, doesn't it?
Yes, and Paul Ryan, former vice president candidate and former Speaker of the House, he wrote an op-ed about this last year. I mean, it makes complete and total logical sense that if you have stable coins that are backed, or, let's legislate stable coins the same way we legislate money market funds, we create a demand for treasuries. And in fact, stable coins are now a very large purchaser of treasuries. So, we're moving into a digital payment system. And as we're talking about a recording today, the Federal Reserve is having a symposium on crypto and Bitcoin in the payment system. And they are now seeing the light, saying that they need to open their system up to Bitcoin and crypto. So the evolutionary process is happening. And to me is, how this evolves is along the lines that the US dollar and the US treasuries are going, I would rather own them than the euro or the 10-year French bond or the German bond or the Greek bond. I think it's, you want to say it's the best house in the bad neighborhood. Fine. But the narrative of excessive levels of debt needing to be inflated away has been a theme that's been around for decades, and it's not profound. True, David, they're going to run it hot, and they're going to get nominal GDP going. Isn't it interesting this time around with the gold rally? We're not seeing any changes in margins, right? We're not seeing any gold being sold by central banks. I think the central banks that are holding a ton of gold are very happy with the appreciation of gold. It gives their balance sheet help. So I think this is just a step-by-step move where we're going to reflate our way out of this. And gold has taken the front page right now. I think it's going to pause. And other asset classes are going to take the mantle. And I would suggest to you that right now, the best guess would be Bitcoin and Ethereum.
Which has more upside right now, Bitcoin or gold?
Bitcoin. For the next 6 months, Bitcoin has more upside than gold.
Okay. Are you then also saying that stocks have more upside if we're making the assumption that Bitcoin is still correlated with stocks?
Yes. I mean, typically speaking, the fourth quarter is the weakest quarter for gold. So I am very comfortable with stocks going into the spring and Bitcoin running and gold having let's add silver, and gold and silver having a very healthy consolidation pattern and to grind for a bit. That doesn't mean that the rally's over. It's not over, but they've gone way too far, way too fast. You have too many short-term traders in. Let them get out. Let the system flush. Like with Bitcoin, the leverage has been taken out of the system in Bitcoin. So I think that's a much more attractive trade on a tactical basis. But David, look, in the long frame, and looking at it at 50,000 feet, gold and Bitcoin are the manifestation of the same trade. So trade your bucket of Bitcoin and gold accordingly.
The notion that stocks and risk assets may still have momentum to the upside, is that predicated on A, economic growth, B, Fed loosening policy, C, fiscal policy, all of the above or none of the above?
Oh, so you've got a brand new sheriff in town in terms of fiscal policy. So we're just introducing supply side economics into our genre. We're moving away from Keynesianism. That's one. The Fed's going to cut. The Fed's going to stop QT. So that's another. And, you've got this period of time, whereas if you've got 100% tax deductibility on capex and you've got a need for energy, you're going to see earnings growth in particular areas of the economy.
Let's talk about the trade war. The ongoing trade war with China, US and China, is now ratcheting up. 100% tariffs on China now announced by Trump, expected to take effect November 1st if no deal is reached before then. Jim, what's going to happen to the global economy? And more importantly, for US and Canadian audiences, the Western North American economies, once this takes effect, if it does?
Well, if it does take effect, it's going to be very painful. I just think what we're doing is we're living the art of the deal, where Trump and Xi are doing their dance. everybody needs to live with each other. Trump and Xi are going to cut a deal, and they're going to live to fight another day. Look, at Trump needs the market to be much higher by the midterm elections. He's going to temper his rhetoric. I think we go to 74 to 7,500 by the spring, a normal little correction, and then 8,000 by the end of next year. So I'm really not, I am not getting head faked away by the tariff fear like so many other people are. And it's, since April, it's our clients at Wellington have been taken, have been treated very handsomely by taking that tap.
Okay, we have to look at this week's inflation numbers. It's coming out Friday. CPI is coming out Friday. People are watching for it and waiting for it. This leads back to the tariff discussion. Are you expecting the inflation number this week to come out even hotter than the previous month? In other words, are you expecting tariffs to finally show its impact on inflation numbers?
I think you may see a little bit of an uptick, but David, if you input market-based real estate numbers into the CPI and PCE, you've got very low inflation and you've got very low PCE. Lennar in their last quarter said, year over year, new home selling prices are down 9%. The Cleveland Fed new rent index is significantly negative. Even up here in Canada, everything has been driving the CPI number is shelter, which is a lagged flaw variable. So I think people are going to see beyond that and realize the fact that the economy is also the real estate market. The employment market is not balanced. It's slowing, and we're in this period of time where the Fed's going to stop QT, stop MBS sales, and bring rates down to 275, the neutral rate. That's our trade between now and the middle to end of 26.
With interest rates coming down to that kind of a level, what do you think asset prices will do in response?
They'll go up, right? And I think the interesting thing you're recording from Vancouver and I'm in Toronto.
Correct.
I think the interesting thing for us is going to be, I think the Bank of Canada has to get their interest rates down to about 1%. Will the real estate market in Vancouver and Toronto, which are very expensive on a relative global basis, do we start to see a bounce or not? That will be the question.
Just on that note, since you've touched on Canadian real estate, much of the real estate in Vancouver, the valuation has been propped up over the last 15 years by foreign buyers in the Middle East, in Asia, China in particular. How much of that is going to be sustainable? Right now, we're seeing a bit of a dip. I'm not sure about Toronto, but in downtown Vancouver, for example, rent's starting to slide. Condo prices have been sliding for more than a year now. And with tensions between China and the Canadian government, not great. I wonder how much of foreign support is going to be given to the real estate market going forward, or if that's even an important variable. How do you assess that?
Yeah, I think it's a knock-on effect of the global financial crisis when the Canadian banks didn't blow up. And when that was the case, I think, foreign capital said, you know what, Canada is a safe place to be to have some money. And the way to do that was through buying real estate, whether you were from China or from other areas of the world. I still don't see that going away. Yeah, and could you have a little bit of a pullback here or there? Yes, but I think, Dave, the more importantly, it's going to be very interesting to see how real estate as a whole in a global framework competes against gold and Bitcoin and other assets as interest rates come down. Will they have the leadership position that they had in Canada after the global financial crisis? I say no, but it might go back to their traditional appreciation. And I think with that, then I think gold and Bitcoin will probably outperform real estate over the next 5 to 10 years. But I am not calling for a real estate crash.
There's some regional banking problems that's happening in the U.S. right now. Zions Bancorp fell. Western Alliance Bank shares fell. And J.P. Morgan, Jamie Dimon, I believe, told the media that he thinks regional banks are cockroaches. Is this a precursor to a larger systemic banking crisis that we're seeing right now?
No, and I guess I wish Jamie Dimon would just I think his franchise in terms of prognostication on the markets is getting a little bit extended. Look, there's going to be criminals or malfeasance in our market all the time. So we had a situation where a loan portfolio was pledged a number of times. I get it, and that's bad, and it's serious. It has nothing to do with the global financial crisis. Okay, the global financial crisis was caused because of near-term money instruments we couldn't settle, and the money market funds broke the buck. Okay, that's what happened in September, and it was a settlement issue. It's a shame that a leader of a major money-centered bank would actually say something as, I'll call it as lazy as that. So in investing, in any financial institution, the United States, Canada, money-centered banks in Canada or the United States, there's always a problem that their loan process, doesn't do a good job in terms of due diligence. Fair enough. We have write-offs for that. I get it. But that doesn't mean that we're going to have a global financial crisis. I mean, David, that's where I think we for whatever reason, because of social media, people selling books or people selling newsletters, every event that we deal with, we take it to the 11, to use Spinal Tap, where it's a global financial crisis, or the US dollar is never going to be used again. It's great for selling subscriptions of books, but as long-term investors, I mean, I would sit there and take the other side. I think there are very good regional banks that are on sale right now. And Scott Bessent has said that he wants to deregulate US banking, specifically the regional banks, because the money-centered banks were not getting money into into Main Street. So I think yes, on a case-by-case basis, it's not the global financial crisis. Let it settle out. And again, Mr. Diamond is giving an extrapolation. I don't see it happen. Remember, he hated Bitcoin. Now he loves it.
I want to come back to Bitcoin in just a minute. Okay, so which of the Trump administration's policies regarding either trade or business development or deregulation have benefited American businesses most? In other words, let's identify the most pro-business policies that he's enacted so far, and which sectors in particular have benefited the most from these new policies.
Well, I would say right now, the one that everybody should focus on is the 100% expensing of capex. So I think that is going to drive the hyperscalers and anybody in capex to basically invest within the United States. And that is a tangible thing. So companies I'll just use Meta or these companies that are generating huge amounts of free cash flow now have a question to ask when they're determining how they're going to distribute it. Are we going to buy back stock, pay a dividend, or are we going to spend money to basically go for the holy grail, which is artificial general intelligence, right? And if we get that, then I think that's where the growth comes from. And I think that's great. And so that's where I think you're going to see earnings growth for the markets go. So that, to me, that's the most important. We still have to come on, we still have crypto deregulation. We still have a lot of other deregulations within the energy industry that are going on. But, to be clear, it's these pro-growth supply-side policies that happened in the 1990s as well, right? Even under Clinton and Gore, that generated fantastic economic growth. And at the same point in time, brought King dollar back to the forefront. And I think that is the trade that people, or the positioning people have to square the circle with. We could be in an episode for the next 5 years where the dollar has a substantial, strong counter trend rally and is strong, even though maybe the long-term theme is that there's going to be a weaker dollar. I suggest to you that people have to start thinking about this as opposed to just saying that the dollar is done and dusted.
Let's talk about the new Bretton Woods 2.0 that you mentioned to me in December 2024. You were on the show after that.
I think people are missing the larger picture going back to Bessent in the sense that we are going to renegotiate Bretton Woods 2.0. Paul Ryan wrote a very interesting op-ed in the middle of the summer. And if, I'm just going to bore you for a sec here, David.
Yeah.
What people miss is that when we take $1,000 and convert it into a digital wallet, then we buy Bitcoin. There's an intermediate step, which is we convert it, or called digital transformation, where we convert it into a stable coin. Okay. They're going to legislate stable coins to be backed by US Treasury. Okay. When you do that, what we have just done, just because of that simple little step, the bill is on President Trump's desk. What it's going to happen is if Bitcoin goes to 20 trillion or the same size as gold, you have just created a massive demand for US treasuries. And you know what that means? That whole narrative of fiscal dominance, that interest rates have to go higher to finance the debt, go down. It gets flushed down the toilet.
But I want to bring up that particular interview. It was a rather prescient call, because what happened post-December 2024 was a series of new policies and legislations. The Genius Act I've mentioned. Let's go back to the Genius Act one more time. What definitively would you have to see to validate your thesis that treasuries and stablecoins in particular are going to be the new backing for a new Bretton Woods 2.0? What landmarks and goalposts do we need to get?
We'll get through that act, get through the Clarity Act, and then just allow this technology to start to permeate throughout society, right? And we want it right now. We want it, we want it today. The policies are now set in place to anchor the US dollar and US treasuries within the stable coins. And so from that, let's allow the evolution of the technology to reach our global economy and take care of it. And as it does that, there's going to be a demand for US treasuries and the US dollar. Now, is it going to supplant it? No. But at the same point in time, it's the beginning, and let's let this evolutionary process begin. So look at Trump's the Bitcoin or the crypto president. And so, the Fed is finally getting on side. Blockchain is going to revolutionize Wall Street. I mean, when you think about Wall Street and New York finally recognizing that New York City should be the crypto financial center of the world, and they do, imagine what type of innovation is going to start to come through with tokenizations and with these large financial institutions finally putting the back end of our financial markets on the blockchain. So it's already happening, David. There's not going to be one definitive aha moment, but it's going to be slowly and surely we're going to see this technology take hold.
This is from the Treasury website dated last October, a year ago. Digital assets and the Treasury market. In this presentation, an interesting statement here: increased inclusion in demand. Tokenization can make treasuries more accessible to a wider range of investors, including smaller retail investors, through fractionalization and those in emerging markets. Let's unpack this. They're going to fractionalize treasuries through the blockchain and hopefully gain access to a much wider investment pool. First of all, let's talk about the second order effects on the US dollar itself and the term premium.
I just think when you think about what this means, is things are being put in place for the US dollar to hang around and be a major player. Then when you start to fractionalize something, think about you can purchase $35 worth of a U.S. Treasury. You don't have to buy $1,000 if your broker will give it to you, or you have to buy an ETF or an actively traded fund. You can basically invest directly in a proportion of a bearer asset. So it's going to change everything. It's going to change settlement. It's going to change the way profits are determined on Wall Street. It's going to change how we settle trades on Wall Street. So it's a massive revolution, which I would suggest to you that Wall Street has been, through regulatory capture, has been trying to put off. And I think what the Trump administration has done is basically said, we're going to allow evolution to happen, right? And then, David, so it's going to happen. Now let's see how this evolves and who the winners and losers are. And I would suggest to you on Wall Street, those people and those institutions that do not embrace will be left behind.
Is this going to start some sort of mini banking crisis? Let's suppose stablecoins can start issuing yields. So you buy a stablecoin, you put it in your wallet, and you're earning a yield. Well, why am I putting my money in a bank then? That's going to spark a huge, massive bank run, isn't it? In theory.
They better start innovating, right? I mean, think about what's happening with Michael Saylor and MicroStrategy, right? I mean, think about what's happening with Tom Lee and his Ethereum trust. Yeah, I mean, look at there is billions and billions of dollars of stranded capital on Wall Street. And now you've allowed innovation and competition for it. So this is why traditional banks have to innovate or they go away. And that means those banks that do innovate and evolve should get a higher multiple, shouldn't they? And that's why when you look at Michael Saylor and you look at strategy, you should look at their Bitcoin holdings as pristine collateral. You just asked me a while back about, what about, Jamie Dimon saying there's a cockroach theory and yada, yada, yada. Well, here's what I know about MicroStrategy and their collateral and their capital. It's pristine and it's on the blockchain and it's 100% transparent. How many banks can you say that about their book? They better be careful because the wave of innovation is coming. And unfortunately, or fortunately, depending on how you are as an investor, the average investor hasn't woken up to this. And, it's the Jim Chanos, we're going to do what you do. And we're going to short MicroStrategy and buy Bitcoin without even taking the long-term view. What is Saylor going to do with all that Bitcoin? He's told you he's going after the stranded capital on Wall Street that Wall Street banks have had to themselves for decades. That is the battleground. And if you can provide yield, safe yield, then you've got a competitive product that goes against the status quo on Wall Street.
All right. Well, let's finalize the portfolio allocation aspect of the conversation here. So given everything we've talked about, what are you overweight right now?
I still like growth. I still don't think the AI bubble is anywhere close to popping. In my bucket of, let's say, the debasement trade between having a bucket of, let's say, Ethereum, Bitcoin, gold, and silver, I have been, for the last month, banging pots and pans saying, get out of gold and silver and buy Bitcoin and Ethereum. I think that's a great trade. And I also think you really have to start sniffing around interest rate sensitive areas in the market because the Fed is going to stop QT and they're going to cut rates. So you're going to, and the bond vigilantes will have to finally wake up to the fact, and they are, that the long end of the curve is coming down. The United States has the flattest curve. So you've got to understand and wake up to the fact that all of these Cassandras that have been sitting there screaming that the U.S. debt market is toxic and going to blow up is absolutely 100% wrong. Where are they now? You don't hear them. 6 to 8 months ago, David, what did we hear? Daily, 10 years going to 10%. It's under 4, Dave. It's under 4.
Okay. Interest rates. Let's talk about the 10-year into 2026. Where is it going?
Next stop, 350.
Okay.
350, 350, but it could, and all of these things you could overshoot because of the craziness that's happening, right? I mean, the problem with the fixed income market is hedge funds are now a predominant player. So you could get overshoots to the upside and the downside. I think, I think the other interesting thing is going to be is when the Fed stops contracting their balance sheet, they're going to stop selling mortgage-backed securities, which means mortgage rates are going to come down faster than the 10-year.
On the economy, we've talked about the U.S. Let's close off in Canada and the U.S. now, because we're both based in Canada. You've argued that Canada lacks perhaps a cohesive industrial policy. It lags behind the U.S. on tech and AI. The CAD weakness in the past has maybe reflected productivity. Now, what is Canada's playbook to turn this around?
Canada has to basically recognize that Trudeau and Friedland's economic policy for the last 10 years have been an absolute catastrophe, and they have to start working back. And I think that's what Carney's going to do. And if you think about what Carney's trying to do, what are the short-term solutions? Look, David, let's be honest. We don't have a big enough economy here to have an auto industry. Okay, Doug Ford here in Southern Ontario is freaking out. We don't have it. We've got to get to our competitive advantage and start exploiting it, and that is natural resources. And then pivot and become an AI superpower. So I would expect the Keystone to be built. I would expect, and Carney has the power. But at the same point in time, it's going to take a long period of time for Canada to get back on its feet again. The United States is in a much better place. So I think Canada is going to go through a balance sheet recession. I think the Bank of Canada's lagged. I think the United States is in a different position because the U.S. consumer is not as bad off. And then if you bring rates down dramatically, you could get the consumer really starting to support the economy along with the capex. So I think the United States is the place to be in terms of economic growth. That's why I think all the Fed has to do, and I wish they would have done it because monetary policy has such a lag. If they get the Fed fund rate down to, let's say, 275, 250 and stop QT, I think the U.S. economy is going to kick in and be okay. I can't say the same for Canada.
Carney used to head the Bank of Canada. Do you think he's putting on the same amount of pressure to lower rates on the Bank of Canada as Trump is with the U.S. Fed?
I think, but he's a central banker, but he's also a Wall Street veteran. And I think that he understands the decision that needs to happen. I think he clearly understands the difficult position that Canada is in. And I think he really understands also that shall we say, how we feel as a community up here is we are tired with the climate change narrative. And we know that because according to Angus Reid, 60% of Canadians want pipelines. So I think he's going to put in place on starting November 4, he's going to use the government balance sheet, which is in a much better position than the Americans, to basically support the economy. I think he's got to deal with his cabinet, which are basically Trudeau acolytes. But at the same point, I think he understands what he needs to do and he will do it. The question is, how long will it take for Canada as an economy to recover? And then, Dave, I think the other question is, how does global capital respond to it? Right? I mean, will global capital respond positively? I think they will. But here's the thing, Dave. Gold is 13% of the TSX right now. Right? The only thing that's really saved the TSX this year was having a massive weight in gold. So, I think the big run in the TSX relative to the S&P is over because the big run in gold is over. Like, you've made your money. The big money in Agnico Eagle has been made. Right? The big money in gold has been made. Now with the pullback, everybody's going to rush in to make their portfolios look good because they're going to have 2 to 3% in gold.
Are you bullish on the Canadian dollar then? In other words, are you bullish on Carney's policies?
No, I think the Canadian dollar is going to hang here for a period of time. I think if he doesn't embrace changing and understanding that the industrial policy of Canada lies in Quebec, doesn't lie in Quebec and Toronto, but it lies in Alberta, Manitoba, and Saskatchewan. Once the industrial policy moves west, then I think we're going to be okay. If he does not do it, David, then the dollar is going to go, the CAD's going to go under 70, like down to 65 to 63. He has to do this. And he's a smart guy. He's pragmatic. He'll live to fight another day. But the question really comes, is what does the TSX do? What are the risk assets up here in Canada? Are we going to get a commodity super cycle? Canada has a ton of rare earths that we haven't developed. We've got LNG in Newfoundland that hasn't been developed. What does it look like when we build pipelines to Churchill and make Churchill a 12-month tidewater port? He can build and spend money and also kill two birds with one stone by developing his commodity resource economy and also satisfying the 5% he needs to spend of GDP on NATO. So it's going to happen. He's very smart. How do risk assets respond? And I would say to you that, with 13% of gold now in the TSX, that's typically significantly too much. And we need a pullback. And then let's go back to our conversation about real estate, David. What does the Toronto and Vancouver real estate look like at 1% Bank of Canada overnight rates in the spring? Okay, that's one, right? Because I'm thinking Canadian banks. And two, listen to what Carney says when he's in the Oval Office with the president. There's a lot that happens between the United States and Canada that they agree on in terms of trade. There are areas of competition. David, one of the areas of competition is financial services. Canadian banks can over-earn up in Canada because they are protected by the regulators, over-earn up in Canada and take that excess capital and take it to compete in the United States. I think that is going to be up for discussion between Carney and Trump in the sense that, so what's up for competition? Dairy farmers in Quebec, telecommunications, so that would be Rogers, airlines, and shall we say banks. And I honestly think that the financial services industry they're going to sit down and they're going to figure out how to be 100% free in terms of competition. And when I say, and I'll say this, I say read to a lot of people, read the room. And here's the thing I'm so surprised about, Dave. Mark Carney, before he became prime minister, was the head of Brookfield. Brookfield moved their head office to New York City. Brookfield's a U.S. company. I rest my case.
Did this happen before? This happened before Carney took office, right?
This is one of the last things he did when he was the head of Brookfield's. Yes.
Yeah. Let's wrap it up here. Great talk. We'll follow up more on the Canada-U.S. situation. And let's just see how Carney and Trump's relationship develops. It's only his first year in office, both of them, actually. Trump's second term, but you know what I mean. Thank you. Where can we follow you, Jim?
Dr. J Strategy. It's on X or Wellington-Altus.com.
Okay, we'll put the links down below. Follow Jim there. And don't forget to subscribe to this channel. Stay tuned for more, and we'll see you next time. Thank you, Jim.